HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
India stands at the crossroads of extraordinary growth, where private markets and alternative investments are emerging as powerful engines of wealth creation. And at the same time, global markets continue to reshape financial strategies, demanding bold decisions and a keen understanding of future trends. Tonight, we will decode these complexities, offering insights that are actionable, forward-looking, and designed to give you that edge. Brought to you by HSBC, a global leader in wealth management and private banking, along with CNBC TV 18, this summit promises to be an evening of insights, ideas, and inspiration. And now, ladies and gentlemen, to set the stage for this evening, I would like to invite Sandeep Batra, Managing Director and Head International Wealth and Premier of HSBC India, to deliver the keynote address.
Delighted to be here today. I think not a surprise, HSBC has been around in India for a long time. I think that long time now is about 170 years. Just this weekend, we celebrated 100 years of a single branch in Calcutta. So clearly committed, long-term, focused, participating across businesses in the corporate bank. Just 2 weeks back, we announced entry into 20 more cities in India. RBI allowed us to give 20 more branches. So you will see a lot more HSBC across, as you crisscross the length and breadth of India. We are here to talk about the wonderful investment opportunities around the world. We have some of the best and sharpest minds. We will talk about alternates. Now, alternates is a very broad term, but we will try and decode some wonderful asset classes within that. And we will talk about how could you get opportunities of investing into that, what are the themes around that, what are the themes around private credit. So as we gather these very sharp minds, I'm looking forward to a wonderful sense of interaction. Let's make it interactive, let's make it fun. Let's get started. Thank you so much.
Thank you, Sandeep, for setting the stage for the evening. Ladies and gentlemen, we now move on to our first panel for the evening. It's titled Market Outlook 2025, India and Global Perspectives on Economic Trends. I would like to invite Prashant Nair from CNBC TV 18 to moderate this panel.
Markets over the last couple of years have done extremely well. And of course, last couple of weeks here in India has not been all that great. So we'll discuss all of that. And I think we'll start first with the global outlook, especially with regards to the US market, which by far has been the best performing market over the last few years. Willem, let me start with you. I mean, I have to ask this, is DeepSeek a threat to US exceptionalism?
The global economic outlook is strong, is resilient for the US, and to a very large extent because of that innovation that is happening in the US, because people have been underestimating, economic growth in the US for quite a long time. We didn't get that recession, and in fact, we also, even more importantly for markets, we are getting that earnings growth, and that is spreading. So even, our message, even before the DeepSeek news, has been don't just focus on the Magnificent Seven, because actually what you see on the graph there on the right-hand side is the acceleration in earnings is actually elsewhere, is in the 493 stocks. And that is because of that productivity growth, falling cost pressures, etc. Now, one of the big drivers of economic growth and innovation in the US and around the world is going to be that whole AI ecosystem. And again, what I emphasize here typically is that it's not just the chip makers. I actually think that the infrastructure around it and the beneficiaries of that innovation, the adopters of AI, are going to be the big winners.
It's not just 7 stocks, it's the other 493 which have also been accelerating.
Exactly.
Because, we typically only talk about those 7 names, the Magnificent Seven in that sense, right?
Exactly. The forgotten 493. Those are going to see that acceleration in earnings and therefore that support.
All right. Let's talk about opportunities in, public markets, private markets, as you were referring to earlier. People always complain about valuations now more than ever because markets have done so well. Where are opportunities, especially on the private side?
So on the private side, first, what I'm highlighting here on this chart is that 85% of the companies in the US that have more than 100 million in revenues are in the private markets. So if you're not invested there, you're missing out on a lot of opportunities. And to a very large extent, this is true in many of the economies around the world. There are entire sectors that are not really that represented in the public market. We also think that you're going to have much more activity in private equity this year, in part because you have a lot of corporates, trade buyers potentially, that are sitting on a lot of cash that can now borrow at cheaper levels, and that see that, that gap in valuations between public and private markets. So they want to arbitrage that. M&A and IPOs are still 40–50% below normal, but we think that is going to increase. Also, the US administration is much more friendly to M&A than the previous administration. So I think that is an area to look at. The other area that we really like is infrastructure, and it comes back to the AI bit. Clearly, infrastructure is not just about roads and bridges, it's also about electricity, and we know that we are going to need every single potential way of producing electricity.
Because India is investing a lot, building out a lot of capacity in renewable. I mean, wind, solar, and so many sort of new companies, both in the listed, unlisted space as well. So you think that is a space which will continue to grow, despite, that's very much in the mix in that sense, right?
Yeah, I do think that is the case, yeah.
Absolutely. Let's talk about India a little bit, Abhilash. What's your sense? Tariffs may not hurt, but higher tariffs don't necessarily help, right? So at the margin, do you think the global environment has become a little more adversarial for India, and we, in any case, find ourselves in a bit of a slowdown right now?
I think we need to take a step back and look at the bigger picture. We expect India to grow at 6.5% this year, which is much higher than the 2.7% global growth that we are expecting. If you look at some of the catalysts that are on the horizon, we think that rural consumption is showing signs of picking up, especially after the strong monsoon season. We are seeing high frequency data like PMIs, industrial production being in the positive territory. And we do expect an acceleration of government capex. So we think that the growth should stabilize around 6.5%, which means that India will be the fastest growing major economy for the next couple of years. And we do expect India to become the third largest economy by 2029.
Earnings, Abhilash, what is your sense? You think earnings growth will there was a sharp slowdown in the second quarter. Third quarter, October to December, expectations were there's going to be zero earnings growth. But I think till day before yesterday, earnings growth is running at about 12%. So it's running better. Do you think we'll end 25 on a slightly better note as compared to what people were penciling, and then 26 expectations will be what, 15%?
Yes, so we are looking at mid-teens kind of earnings growth for calendar year 2025-2026. And clearly, with this sell-off we've seen, earnings delivery will be under spotlight. But when I think about the downside risk, I think it's very, very important to look at the state of the overall economy. So we talked about the fact that Indian economy should grow at around 6.5% on real terms. But on a nominal basis, that's growing close to double digits. So that, to me, caps the downside risk as far as earnings are concerned. Timing the market is very, very difficult. And if you do get the timing wrong, it can be very costly. So over the last 25 years, Indian equities, MSCI India has delivered a return of 9.6% on an average on an annual basis. But if you were to miss the best 25 days, so on an average one best day per year, the return would be 2% per annum because of the compounding effect. Now, you'd have to be really, really unlucky to miss all those 25 days. But it just shows you that if you do get the timing right, if you try to sort of sell and then buy at the lows, and if you get the timing wrong, it can be quite detrimental to long-term returns.
Shriram, let's come to the fixed income market here in India. So we'll get the Fed decision today. Actually, over the last many days, whenever we've had people come up on the show or come up on our shows, we asked them what the expectations of the budget are. They said, well, forget the budget, let's watch what the RBI does. And then, of course, the RBI did ease liquidity up a little bit. We'll hear, I don't know, if something new from the Fed tonight, but what's your sense on rates here in India?
I think over here, clearly one is we have to keep a very close eye on what's happening globally, especially the US Treasury market. We've already seen since October, the pre-run-up itself, Treasury yields really moving significantly higher, currency moves, etc. So that uncertainty, I think, is something that we are going to deal with over the next few months and years as well. Now, if you look over the last 3 months, Treasury yields have moved up 100 basis points. Indian bond yields have moved down by about 10 basis points odd. So that shows clearly that, at least as far as our bond markets, fixed income markets are concerned, I think what matters for us a lot more is what's happening domestically. And that's really the interplay between growth, inflation, obviously RBI, the change of guard, all of that comes into play.
The inclusion of government bonds in sort of global indices, right? FTSE, MSCI, Bloomberg, etc. How do you think it'll happen? And actually, we already have a timeline in that sense, right? How will that change things, in your opinion?
No, I think that remains a very positive tailwind, I think, for us. And the good part is these are the typical real money EM funds. So while, like we saw in October, November, we did see a little bit of moderation in FPI inflows into bond markets. Like we saw in December, it came back and it made up for some of that. So I think the $25 billion that, let's say, the JP Morgan GBI EM is supposed to bring in, we think that's on track. We are now at about 18 to 19 billion of inflows since September 23. So that's a good amount of inflow. And the other two indices, we think, should lead to about $8 to $10 billion of inflows. So between now and March 26, I think that's still a good $15+ billion of incremental flows into our bond markets, which just makes the demand-supply situation continue to remain fairly positive as far as our government securities markets are concerned.
I just want to ask you, just last question to you, Willem. This President Trump's policy, America first, is it going to be at the expense of everyone else, or you think eventually it will be not? It'll be sort of...
Well, I do think that he's an aggressive negotiator, right? There are other terms for that, but they will put pressure on a lot of the other countries around the world. Now, if for example, it triggers a reaction in other countries to also really go for that global competition and put their house in order. I'm thinking obviously of Europe that really needs to be shaken before they do something. Ultimately it could be a positive for their longer growth model. But I do think that you're going to see lots of ups and downs in terms of the sentiment in the market, and for the lags, for example, on Europe, first a move down before then they act, and you could see that in other countries too.
Thank you, gentlemen. Thanks very much.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18. HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
Now, alternative investments, including private equity, venture capital, and private credit, are transforming the investment landscape in India and the way we do business. With their potential for higher returns, risk diversification, and funding innovation, these trends are emerging as cornerstones of modern portfolios. To uncover the key drivers behind the growth, the evolving landscape with their opportunities, and the strategic role these investments can play in building resilient portfolios, I would now like to invite on stage Surabhi Upadhyay from CNBC TV 18 to moderate this very special panel.
Alternatives, right? I think it's a very, very interesting topic at all times, especially now. If I could just play on the word itself, given where the equity market, the listed equity market is, I think everyone's looking for an alternative. Is that not right? But gentlemen, great to have you here to sort of dive a little deeper into understanding this asset class, where we are in India with respect to it, and really what are the opportunities perhaps ahead. So let me start with some opening thoughts, get the panel's view on the drivers behind alternatives as an asset class and where Indian investors are in that journey. Anshu, let's open with you.
Well, let's try and demystify this word alternatives and maybe give a top-down view of what the asset classes are, what the size and scale is, and what is the relevance, more importantly, for this audience. What's happened in India is alternatives as a category has been growing for the last 15 odd years. I'll give you some numbers. India's market cap, we all talk about it, is $5 trillion. Mutual fund industry is, let's say, about $800 billion. Private equity invested capital only for the last 10 years is $300 billion. This is twice the FPI net investment in India over the same time. FPI has put put in $150 billion, private equity is $300 billion, right? Commercial real estate is another $200 billion. Commercial real estate, maybe on that point, India is globally relevant. We, as a country, absorb 50% of Asia Pacific's commercial real estate demand every year. So a city like Bangalore in the last 5 years has consumed as much commercial real estate as Shanghai. Imagine the size and scale difference. So you are also globally relevant, and these asset classes earlier were built on the back of dollar capital. All these endowments, foreign funds, institutional investors, they came into the country and they built the size, the scale, the sophistication, and so on.
Okay, very interesting. Prashant, your thoughts on how this asset class is moving along and also sort of competing with the regular listed equity space and PMSs and the regular mutual funds?
No, I think alternates is a fairly broad term, and there are spaces in which mutual funds typically don't play, like credit, like unlisted. And even in listed equities, alternates can bring in greater focus, greater customization. And I think this is an evolving space growing rapidly. And our share of alternates is still much below what has been experienced globally. So I think this is here to stay and grow. And I think it should be looked upon as a great complementary product to the mutual funds.
Neeraj, your opening thoughts?
On the private credit, it used to be a very small industry, maybe even 3 or 4 years back, let's say pre-COVID, right? Average deals in India used to be about $2.5, maximum $3 billion. 60 to 70% of that used to be done by global funds, and they used to generate about 20% IRR. This whole segment, which was effectively available for dollar capital, the Indian investors did not have access to at all in the past. Today, that has completely changed. If you look at 2024 numbers, total deals were $10 billion. They're, of course, smaller than the equity sizes yet, but they're $10 billion in value. Equal amount has been raised from domestic investors to invest. Just last year, there were 76 funds that were launched between 2019 and first half of 2024. 13 of that were just launched this year in the first 6 months of the in 2024, first 6 months of the year. So clearly on the demand side and on the investor side, there is acceptance for Indian money investing in private credit.
Talking about between early stage, mid-cycle, late stage, where do you see, the best relative risk reward within private equity? Which kind of sectors? Where do you see the action?
See, our thesis has been a little different for this audience and this investor base, is that we have taken a call to stay focused on building the late stage private equity ecosystem. The reason being, Surbhi, that even large companies in India compound at 15, 20, 25%. But they may be, let's say, 4 to 5 years to the IPO or 3 years to the IPO. And Indian markets, so then you don't take mortality risk. You're not taking business execution risk. The product is there, the team is there, the company is scaled up, all of that is there. So business is unlikely to die, right? They need capital for growth. There are special situations for which they need capital, but there is a clear path or stated path to IPO. There, your risk underwriting is far more superior and then the tenor of the product tends to be 5 to 6 years. You're not taking a very long tenor that in 10 years things can change. So our thesis has been that. The second thesis has been, we are not sector focused. We are not deep tech or robotics or healthcare or retail. We follow India as macro. So consumption, consumer brand, consumer tech, all of that will come in that. Then we will follow financials and we'll follow, let's say, emerging themes like manufacturing, enterprise, and tech is an enabler for us, right? So that is the big call we've taken to kind of give margin of safety in a very dynamic world.
Which now brings me to the listed space as well. And, Prashant, weigh in on everything that you've been hearing. Clearly, private markets are very exciting, even on the equity side. Your thoughts on what you're seeing in the private space and then the listed space itself, right? Which anyway has been going through pain last couple of months. What do you see ahead and what are you advising, people who come to you?
So I think my understanding of the private space is not up to the mark, so I would leave it to him. But coming to public markets, I think in fact, we released a note yesterday itself. I think the large caps are offering decent value. And the indices have corrected about 12-13%, and there has also been roughly a 9 months time correction. So PE multiples are reasonable. Indian markets are now trading about 17 times calendar 26 earnings, which I think is reasonable because India's cost of capital has dipped sharply. The gap between India and US 10-year yield is at an all-time low of 2.2%, which tells you how cost of capital has moved lower. However, I would be extremely cautious on the small and the mid-cap space.
Even now,
Yes.
despite the fact that they've corrected maybe 30-40%, in some cases more.
I think that space is still very stretched to my mind, and I would be extremely cautious in that space.
On growth, if we are in a bit of a growth slowdown for the next couple of quarters, would private credit be affected pretty much the same way as equity because of the slowdown is a slowdown? Or would the risk for private credit be a little higher if indeed we are in a prolonged economic slowdown?
Of course, there is a risk of any cycle that hits the industry. So from that perspective, there are some deep cycle industries that we don't touch. For example, EPC, we don't touch at all, right? There is nothing in our portfolio that touches EPC. Industrial, hence we are very selective. Which part of industrials we play, which is also cyclical industry. Financial services also we are selective, like we've not done anything in our portfolio which is unsecured consumer finance. If you see the charts earlier on mobile phones that are being sold in the country, 40% of that is actually consumer finance of 40 to 50,000 rupee loans, taking individuals who are taking loans, right? And these guys sometimes don't even make 40 to 50,000 rupees a month, right? So some of these trends you watch out for. Anything that has a little bit of too much float in it, you try and avoid. But conceptually, this is a secured product, right? So typically, whatever your loan is, you would secure it on an average. I think at an industry level, we secure it at 2.5 times. We generally operate somewhere between 3.5 to 4 times in terms of security. So through cycles, we actually push for a little bit of money back. We don't need to get the whole money back, which we do. We've done it also in the past. And hence, conceptually, across cycles, credit, if you do it the right way, could be a better product.
Thank you very much.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.